Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Today is capital budgeting, which I think for many would be a refresher, or maybe you're working with us, maybe you're not. But it is something that I've taught quite often in my, financial management sessions, particularly, and I've done quite a bit of work in the MBA sector and financial management for non-financial managers. And it's always good to come back and just have a look at this topic. I always find, even no matter how many times I teach it, it's a pretty relevant topic when you're looking at decision making and investment analysis. And I think we tend to look at valuations for businesses, and we tend to look at valuing debt and valuing all these other things, but actually looking at projects is something that maybe we don't sit down and do a concerted effort of. When I have my financial accounting hat on, the measurability requirement in financial accounting, when you ask, what are you going to account for, and then can we raise a journal for it? And when we ask, can we raise a journal for it, is it probable and measurable? That actually is a capital budgeting or a net present value calculation almost, because we're trying to establish, firstly, how much should we pay? Is the price right? And secondly, are there future benefits in this project? And that's kind of what a capital budgeting decision making moment is about. Is this right for us? And is this something that we see benefit in? Okay, so with capital budgeting, that's kind of what we're doing. We are looking at medium-term investments. The other useful element to me in this course is just cash flow, doing discounted cash flows, because we do spend a bit of time looking at those discounted cash flow principles, which is useful in a variety of different applications in our work. So that is what we look at, and that is what we're about. So for those of you who don't know who I am or where I come from, the notes have got a bio of me. Never quite know who that person is, but if you're wanting to find out a bit more about me, there I am. And it gets us into the topic of the day. Okay, so capital budgeting is actually one of my favorite topics. It's something I do enjoy, and I think it's something directors and people involved in business, it's one of the ways we can prove that we are being careful and considerate and not being reckless. People can walk in and say, this is a great idea, but this is where we show care and consideration, and that we've run the numbers, as to whether or not we should or shouldn't. And especially if we're looking at multiple projects and we're looking at rationing, later on we talk about hard rationing or soft rationing, where we've got limited resource. There's only so much you can take away from operations and invest in these projects. Capital budgeting is also organic growth. Okay, so when we're looking at businesses and we're looking at organic growth, we're looking at growing our business internally, investing in ourselves, investing in resources, investing in projects, investing in property and plant, investing in markets, in research and development, various different types of projects that you can look at to grow ourselves organically, okay? As opposed to when we do valuations. Valuations tends to be an external growth model where we find other businesses that are already doing well, or have got potential or have got opportunity, or already started the idea that we want to start, and we're not really starting from fresh with them. They've already got the ball rolling, and we are just tagging on to what they've already done by buying the business and not starting from fresh. So capital budgeting being the analysis and evaluation of investment projects to produce benefits over a number of years, okay, as opposed to acquiring a business. We can look at research and development projects. We can look at replacement projects. We can look at a whole wealth of different projects, which we'll go through in a second. They are always part of the strategic plan. So when we are looking at that 5-year, 10-year strategic plan, where do we want to invest? Where do we want to put our resources? And it's really important that we take care and consideration in this, because we're investing over a number of years, we lose flexibility. we can't adjust and change on the spin of a dime, because often these will be 5-year projects or 10-year projects. And once you've gone past that initial investment phase, you're kind of in it until you're done, or you're going to take a loss. There'll possibly be a break-even point, but you're not going to be able to switch to a different project very easily. You can still switch, but not easily, because of the medium-term, long-term nature of these projects. Okay, so that is why we've got to put the care and consideration up front, and why it has to fit with our strategic plan and our strategic goals, and fit with what we're wanting to do. Okay, we are concerned about over or under investment. We've got to find that sweet spot. If we overinvest, we obviously tie up liquidity and we tie up resources that we could use in other spaces and other places. If we underinvest, we could be left behind. Okay. If you look at the tech giants, if you look at the race between, sort of Apple and Samsung and Huawei and Nokia, and, look at what happened to BlackBerry. All of these things are lessons to be learned in why it's so important to stay on top of the development race, and depending on your industry that you're in, being innovative and finding new ways to do things, so that if there's no such thing as standing still in business. If you're not moving forward and evolving and changing and reinventing yourself continuously in business, you're going to get left behind. Okay, and it's just because your competitors are going to be doing it, and if you're not keeping up, then it's a problem. So if you underinvest, you potentially are going to lose opportunities and lose market share. If you overinvest, you could land up with a Titanic, and then you can't really change course very easily. Okay, so really important to get this decision right. As I said, types of investment. Well, the idea of investment is to sacrifice present income now with the expectation of future benefit later. As an accountant, we're always saying this to different people in different ways. An investment is really, I used to say to my students, you're sacrificing 4 years of your life now to be able to sort of have the world as your oyster later. There's always a current sacrifice for a later benefit. That's really why you make investments, is to hope that you're really leveling up later for the decisions you make today, which is why we, again, have to be so careful about the decisions we're making today. So, we'll have, for example, a replacement versus expansion project. Do we replace and upgrade what we're doing now? Those type of decisions are relatively safe. They usually involve cost savings. So say, for example, you're looking at your fleet or you're looking at your motor vehicles. We all know, those of us that own motor vehicles, that at some point we know that it's time to trade in, because the car that we have is starting to cost us more in repairs and maintenance than what it would be to cost us to get a new car. Cash flows are relatively certain because we've been here before. We know what the game is about. And often we get higher than expected returns because we're quite conservative. Okay, as opposed to expansion, where we're going into the greater unknown, cash flows are less certain because we are having to basically guess and estimate what's going to happen. We're often much more optimistic about these cash flows because we are trying to sell it, and often trying to sell it to ourselves that this is a good idea to do. So we're quite enthusiastic, and hence we usually land up with lower than expected returns, and that's just really the nature of the beast. It happens. Okay, so we've got to factor that in as well, that what we're doing, we might not hit these. So, I always say shoot for the stars, and be happy that you landed on the moon. Okay, but these are things that we take into account when we're involved in capital budgeting. Are we replacing existing, or are we expanding? Okay. Other types of investment projects you might be looking at and comparing, projects that are independent. So, we might be looking at buying a long haul truck or buying a new machine for the factory. Okay. Depending on budget, depending on cost, depending on whether these are good ideas, we might buy both, or we might buy neither, or we might buy one or the other, but they don't really impact on each other, as opposed to mutually exclusive projects, which would be well, if I buy the long haul truck, I won't buy the 2 smaller delivery vans, okay, because those are kind of mutually exclusive. I don't need both, I only need one or the other.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.